Hello, welcome back. Shopify is one of these companies that has been completely annihilated during this recent crash. It has been down about 80% in the last few months, and a lot of people are actually interested in the company, myself included. And I have made videos about it in the past telling you that it's a good idea to wait and still keep waiting till you get a good price. What is that price? We're gonna examine in this video. Now you will see here in our stock news module a lot of news popping up telling you about how Shopify is trading as a deal of the century, is very cheap, how Peter Lynch's approach to Shopify, Target and Walmart can potentially help you. Other articles here are talking about a buy and hold, the perfect growth stock, trading at a discount and all that jazz. But we do need to examine this company with our own eyes and not just believe what every article is saying out there. That's not important at all. But you will see that if you bought at its 1 year high near $1,700, you are definitely probably crying in your shower right now in a fetal position, because the stock is sitting at $370, down 80% almost from what it was. And as you can understand, from this price here, it needs to gain like 500% or something in order to reach this kind of price. So this happens when you are buying stocks that are super overpriced, and eventually it comes to bite you, and hopefully you didn't get it. But the thing is, if you are a new investor here, in this company, you may want to be thinking about what is happening with its financials and whether it is now the time to enter this one. Now, if we take a look at the 5-year chart here, you will see that the company has been completely decimated. You will see it here. It used to be around $1,700, and right now it's going downwards a lot, and it may be a nice discount. So let's examine the financials and see whether that's the case. The PE ratio of the company is sitting at 255, so it's still very, very high, even at this current price, which kinda surprises me, but we will understand why when we take a look at the financials in detail. The price to free cash flow ratio also super high, and it used to be even higher, but 102 is very, very high here. Outstanding shares that keep increasing, and that's something that we also don't want to see, because we're getting massively diluted. And the revenue growth is a good thing about this company. Of course, this is a growth story. It will be growing massively, but we don't want to be overpaying for that growth. Net income growth that also keeps increasing nicely. Free cash flow growth and total equity growth that is also increasing here. Now, the company doesn't have a lot of debt, yet its returns are also not great here, and margins are pretty low. But let's take a little bit of a look at what is happening in terms of their financial statements. From 600 million to 4.6 billion, of course, as you can understand, this is massive increase here, and you can expect this company to continue growing nicely through the years. So that's probably going to happen at least for a few years. And the net income has been growing from negative to basically 2.9 billion, which is pretty great growth here. Now, the balance sheet of the company, you will notice that total equity has been increasing from 1 billion to 11 billion. But take a look at also the additional paid-in capital, which has added some capital to the company, really, from stock sales, from selling stock pretty much, from selling common stock. And if we move on to our cash flow statement, you will see that the net income of the company is laid out here, and the operating cash flow that is provided. You can see it here. There are some last year other non-cash items. This is probably a one-off that's probably not going to happen in the next year, but it cost the company quite a little bit in terms of their free cash flow, as you can see over here, because the company made 450 million in free cash flow. Now, this was a one-off that we're not going to be seeing in the next year, so we may be actually looking at near 3 billion here in terms of the free cash flow that the company generated. But if we take a look at the company's market cap, which we can see here in our stock analysis tool, we will see that it is sitting at 46 billion right now, 46.3 billion. And so if you actually establish a market cap of, let's just say, establish a free cash flow of like 2.5 maybe billion, then that would be happening if there was this, if there wasn't this one-off item. You will be looking at a price to free cash flow that is much less than what it is right now because of this one-off item, probably nearing 20 or 25. And this is promising. This actually sounds promising. But we will examine the finer details in our stock evaluation tool, which we will see now. because the stock evaluation tool doesn't really look in the previous the cash flow of the previous years. It actually uses the margins, it uses the revenue as a beginning point, and then it calculates using margins and not what happened in the previous years. And so if we let's just say the company is going to continue growing nicely and very nice through the next 5 years, 18 and 20 and 22%. Let's just say that the net income margin is probably going to be, I don't anticipate it maybe to be like 60%, that would be way too much, but the net income margin potentially could be something like, let's just say 8%, 8, 9 and 10, let's just say here, is what we could anticipate. And the free cash flow margin here, let's just go with something that's rather typical here, because again the company hasn't had too much profitability here in too many years to make a deduction about what the actual ratio would be. But let's just say it's 80, 90 and 100. And the annual return that we're going to use is 13%. Now, the net income margin could potentially be higher. I mean, last year they did do 63%, of course, but we want to be going relatively safe here and see what adjustments we could potentially make, and maybe assume some other projections for other years. But let's just go with that first and hit calculate, see what we're getting here. Okay, so with this kind of margins and this kind of revenue growth, which I think it's very appealing here and pretty aggressive, we're looking at a low of 65, 66, medium of 90 and a high of 120. Now, the net income margins, as I mentioned, for the company have been all over the place, like 10 here, 63 here. And if you take a look at the last 12-month one, which is actually mentioned in the stock analysis tool, you will notice that it is 3.77. That's like the trailing 12-month period. And so it is going up and down a lot. It is actually tough to make a deduction and be completely safe. So this is why I use something in between 10 and 3. But if let's just say the company actually manages to make margins that are more indicative of their business, really, I would want them to have higher margins. 7, 8, 9, 3 doesn't make a ton of sense for a company like Shopify, but this is what is happening right now with the company. But if they actually manage to make something better, let's just say something like 18%, 20 or 22 here, which basically similar to the same as the revenue growth, then we're looking at a different story. Let's see what's happening if that's the case. Now, if that happens, of course, we have an elevated max price to pay, yet still we are actually expensive, and so the current price is sitting at $370 today, and it may continue a little bit higher, it looks like, since the futures are very green today. But yeah, even with these projections that are very, very confident here, we are way off. And so we cannot really buy this one right now. It still has to drop significantly for me to consider buying this one. Imagine how overpriced it was. It's down 80% and it's still expensive. So you can understand that, yeah, people who bought at the very highs, this is a big issue. Now, will the company be doing great in the next few years? Well, I think so. I think Shopify is a great business. I think they will be increasing their margins and everything here. I think they will be doing better in terms of the financials. Yet right now they are overpriced. They are printing tons of shares, or at least they have printed tons of shares. It doesn't make a lot of sense for me to enter right now. This is an expensive company, even down 80%. Yet I wanted to make a video and kind of talk about it because it's down again that much. That's an insane amount that it is down from its 1-year high. Thank you for watching this one, and I'll see you in the next one, guys. Remember to leave a like and subscribe. That really helps, and I'll see you soon. Bye bye.